Hey guys, welcome to Tickzon where we try to turn our hindsight into your foresight. Man's just out here doing some work in the middle of the night because I went and slept in the afternoon, so man can't sleep right now. So doing some work and just came into my head right now a cool topic to talk about, and I thought, yeah, just turn on the camera and talk about it. So right now we're going to be talking about stocks versus property. Which one should you prioritize? Which one should you be going for? Yeah, straight into it. So, stocks versus property. Um, you know, both of them something I'm involved in to some extent. Property, I mean, I've been coy about it, but it's something that I'm going to be involved in the long term. In the short term, am I involved or not involved? I may be, I may not be. You always listen, even when you don't see people putting something up, there's always something working in the background. Everything I put out here, something that I'm working towards, and obviously it's one of those ones. Instead of me to put it out there when I'm done or have already gotten there, I might as well be putting out stuff while I'm on my way. But stocks and property, what do they have in common? What is the similarities between them? And the truth of the matter is, the thing that combines both of them is that they are both one, investments. They are investments that can return you some kind of either appreciation, dividends, rent. Dividends, rent, pretty much the same thing. Capital gains in terms of it appreciating over time, and also these both are assets. So a stock is an asset. You see people, when people die, they do pass on to their children or in a trust an investment portfolio. And then most of the rich people, to maintain their wealth, will invest in stocks, but they also invest in property. Now property is also a very good asset. It's the difference between the two of them. If I start off, I just made small notes, didn't make really any notes. I really just came into this video to start talking. Is volatility. Now, obviously, the difference between stock market and the property market is that stocks, they react pretty quickly. Like today, you could be up double your money, triple your money. Tomorrow, you could be zero virtually. You could be minus 50% what you had in there. And if you're somebody who trades with options or any of those kind of things, if you're a day trader, you could be losing more money than you're making. Typically most day traders are losing more than they're making. Now, but in terms of the property market, because property is slower to react, just because of the nature of the market, even if like the recession has happened this year, it will take a couple of months for it to hit the property market to either go up or go down. And similarly, all of these markets are also driven by demand and supply. So, which is why, to some extent, property is one of those ones where people generally look at a long term that property will always appreciate. It's not always the case, depending on it. Property depends on, so with what you hear about property is one, location, and it depends what you're trying to get from your property. So when it comes to property, some people, there's different strategies out there, but some people, if you break it down, some people are looking for cash flow in terms of rent. Some people are looking for capital appreciation by either maybe doing up a property or holding it, buying it cheap, holding it for the long term, and then getting a quick return on it. Now with stocks, same thing. Some people are looking for a long-term steady increase in their money as it compounds effects, but some people are looking to build up their portfolio to be getting dividends. Dividends, if you don't know, is similar like rent, basically. And most of them, it's not, some companies are monthly, but typically it's either quarterly or sometimes like 3 times a year that you have a percentage, or let's say for every share you get a penny, or every share you get 59p. And with stocks, you will see that those are, if you ever had like an ETF, or you invest in like McDonald's, Coca-Cola, all of these ones, any of those ones that are in the dividend aristocrats, you will see McDonald's, you will see that they're good. Now obviously one of the issues with both of them is, for some people, is the barrier to entry. Now obviously the barrier to entry for property is much higher than the barrier to entry for property, for stocks. For stocks, every time I speak to people, they're like, I don't have enough money to invest. You can really invest with £1. Like really and truly, for me, some of the stocks that I'm only like £2. I was only in like £2, £3. When I started, I was only investing £20 a month before I put up to £100 a month, and now my total portfolio, just most of it coming this year. I started investing from last year, but only up to about £100 per month, the end of last year. So, but right now it's already at £2,000. So I already over invested what I was aiming to do already across this year. And I still have some stocks, yes, that I'm in just with like £3. I had some change left over. I didn't really want my money sitting there, so I don't want any free cash because I just want it to be appreciating anything. So if my 10p turns into 12p, well, we beat inflation, so that's how it goes. So the barrier to entry for stocks is very, very low, because now what they have for most of these stocks is fractional shares. Because with fractional shares, it means that instead of you having to buy, except for certain stocks, some stocks may not allow you to actually lend with like $1, £1, but most of them will at this point in time, because they just want the money coming in. And even if you don't have to, if you buy half a share, a quarter of a share, you're still riding the wave of the appreciation that they get. You're still riding the wave, and it's just about getting it going. Now, in terms of property, obviously, the amount of money you need to save, typically, if it's for residential property, is 5 to 10%. On average in the UK, it's about 16% that people put down on their first property, and obviously the higher deposit, the easier for you to get it. Whereas if you're going for a rental property, it is 25% typically to do that. And obviously, the longest part for buying a house is the saving process, and also saving, and as well as you get your credit score and your affordability. So the barrier to entry for property can be higher, but similar with everything, the first one is always the hardest. After you buy a home, it's easier for you to get a second home as a homeowner, and obviously at that point in time, it's just about cash flow. So in terms of which one would you prioritize, and which one would you which one in terms of longevity would you be looking at? In my opinion, do both. I myself, I'm going to be doing both. If you look at property is a fixed asset. It's not going anywhere unless it's bought by a developer to change it, and then you get a payout. Or if it's what's the thing? What's that thing when government takes it by force? Occupational domain or something like that. But if you look, for example, I'm in the UK. It's an island. Population is going up. Land is a fixed space, and it means that in time it's only going to go higher. But don't get twisted, it can still go down. So you go into any investment in terms of protecting your wealth for the future with some level of security and diversification. And the reason why I know some people say diversification is stupid, even within your stocks or even within what types of assets you're in, because these are two different asset classes. Stocks and property are two different asset classes. And similarly, during a market crash, stock market crash, it affects stocks. It doesn't really affect property. During the housing bubble of 2008, it affected property, and then reflected in some stocks in the stock market. But stock market, as we've seen during this year, can really bounce back in 2 weeks. The housing market doesn't do that. So when you have your money spread out in different pots to some extent, but pots that are getting you return. Now, in my opinion, if you're going for property, in the beginning of property days, you should just be focusing on cash flow. Focus on the rent coming in, as opposed to whether your house is going to appreciate in the long term. And then as you start using that, start buying more properties to start building up your property portfolio. And then you worry about appreciation later, which can come as long as you choose the right location. If you know in 10 years time or in 5 years time development is going to come in, then that's a good location. Now, in terms of stocks, again, it's a mixture of having established companies there that will earn you a calm return, and as well as putting it in ETFs. Something similar, as I always tell people, FTSE 250, FTSE 100, is it iShares EV vehicle, S&P 500. All of these ones are really good ETFs to get into, which are index funds, which just track those certain markets. And also you can go into growth stocks, into stocks that IPOs. I don't normally say if you're going to research companies, don't just jump on an IPO. You get a notification, new IPO. So invest in those different things. And if you're young, the most important thing about when you're looking at whether it's property, stocks, or whatever, is time. And so when it comes to investments, the best time to invest is generally always now. Now, if you're really smart and you really can time the market, then maybe for you it's maybe hold on watch the market, save your money, and go into investment provided you know. But if it comes to investing in stocks, just invest. Like, you know, start off with SP 500. I'll start off with FTSE 250. Start off with a couple of ETFs. Start off with, you know, I don't really like doing the standard Apple, Amazon, or those ones, but, you know, go into like a McDonald's that's going to be steady. Coca-Cola, they hit you with a cool dividend. You know that they're never really going to go anywhere. They've got enough deals to keep them going. But again, when it comes to stocks, it's about doing research. Look, when it comes to property, it's about doing research, location. Don't buy, you know, do all the checks for the house. And yeah, start building your future. I'm going to be doing my own. My kids better be doing it for their own kids as well. But this is how you want to do to start building your thing. So time is your greatest asset, and the earlier you get in, the better. If you feel like a stock is overvalued now, still buy a little bit of the stock. And then when it comes down, if it does come down, buy a little bit more of the stock. And that's called dollar cost average. So if you buy it at 200, buy it at 300, buy it at 400, it averages out to about 300 across the pot. So if it comes down again, you buy more. But it depends on the time frame of when you want to take out your money. So your money might, you know, double today, but again, don't be stupid and go and chuck all your money in the stock market because you think you're going to be rich. Because I mean, when your investment goes good, like mine has, some of mine has, the first thing you regret is that you didn't put more money. But the anxiety that it'll hit when it falls, that's how easily as it can go. So I just randomly turned on the camera to talk about stocks and property. Which one is better? Neither. They're all, you can get rich off of doing either one. There's billionaires who are all solely started off on each of these, but at this point in time have all diversified into other things. So you can start off at one, but start off at something, because investment is the only real vehicle to secure wealth. And these are assets, so they put money in your pocket. But if they're taking more money out of your pocket then you put in, then they become a liability. Any asset can be a liability, and don't invest more than you're willing to lose. So at this juncture, I thank you for having to join into Tickzon scheme. Let me go back to the work I'm doing. Have a blessed day. Sort out your sleeping pattern, because I know I need to sort out mine. Because what time is it? It's 1:44 a.m. New week, new day. Take care and bless up, guys.